Welcome to the Greater Phoenix Economic Council's Inflation Reduction Act webinar. Thank you to our online viewers for taking the time to watch this briefing. This is an ongoing series of Inflation Reduction Act webinars to help you and your company to better understand and leverage this federal program. My name is Sean Fogarty, and I'm the Vice President of International Business Development for the Greater Phoenix Economic Council. On behalf of the 22 cities, Maricopa, and Pinal County governments, GPEC helps businesses that are considering investing or expanding operations in our region. In 2022, Congress passed and the President signed the Inflation Reduction Act into law, marking the most significant action Congress has taken on clean energy and climate change in the nation's history. The Inflation Reduction Act, or IRA, comprises of grants, loans, rebates, incentives, and other investments. The IRA includes some 24 tax provisions that will accelerate the deployment of clean energy, clean vehicles, clean buildings, and clean manufacturing. For instance, the Inflation Reduction Act includes several tax provisions and significant grant and loan programs to support deployment of commercially available and innovative clean energy technologies. The Inflation Reduction Act also includes funding and tax programs to boost domestic manufacturing of clean energy technologies, including up to $250 billion in new loan authority for energy infrastructure reinvestment and financing, a new advanced manufacturing production credit. The Inflation Reduction Act provides billions of dollars in consumer incentives to put more clean vehicles on the road and commits to making more of these vehicles and their components in the United States. Highlights include a clean vehicle credit for consumers. Qualifying vehicles must meet certain standards, including North American assembly. The battery's components must meet certain standards for manufacturing or assembly, and the battery's critical minerals must meet certain requirements for sourcing or processing. There are other programs to grow the domestic supply chain for clean vehicles. The Inflation Reduction Act includes billions of dollars to support vehicle manufacturers looking to expand their domestic production of clean vehicles. There are many more programs in the Inflation Reduction Act, and we encourage companies to consult with professionals who can guide you through the federal program. Today's webinar will run for approximately 1 hour. I need to highlight our disclaimer. The information provided on this webinar does not constitute legal advice. Instead, all information, content, and materials available on this webinar and website are for general informational purposes only. Viewers of this webinar should contact their attorney or qualified service providers to obtain advice with respect to the Inflation Reduction Act. Feel free to contact GPEC, and we'll be happy to connect you with qualified professionals. The views expressed are those of the individual speakers in their individual capacities only. All liability with respect to actions taken or not taken based on the contents of this webinar are hereby expressly disclaimed. The content is provided as is. No representations are made that the content is error-free. Lastly, I encourage you to visit the GPEC Climate Tech page. Our presenter today is Elizabeth Crouse, partner at Perkins Coie. For more than a decade, Elizabeth has provided business-focused solutions for U.S. federal, state, and international tax problems in a variety of transactions and investment structures. Her clients include top-tier strategic and corporate investors, developers, and operators in the renewable energy and fuels, hydrogen, and carbon capture industries. Elizabeth, the floor is yours.
Great, thanks so much, Sean. Pleasure to be here today. Thanks for the introduction. I'm going to go ahead and share my slides. Now, what we're talking about today is federal tax credits for renewables, and this is going to be a bit of a crash course, so we're not going to go into tons of details. What I'd want to do today is sort of give you an overarching idea of where we are with the federal income tax credits for renewable electricity, renewable fuels, carbon capture, and then also electric vehicles and hydrogen fuel cell vehicles. There's a lot of different kinds of things that are incentivized with tax credits these days. Way too many details to go into it in an hour, but also happy to pick up the thread with anyone offline. So let's start with who cares about this stuff. Now, tax credits are, they sound like a really fun play toy, right? A fun tool, and they sound wonderful to people who have a tax bill. But not everyone who engages with tax credits in the United States actually has a tax bill that they care about. Usually what we're thinking about when we think about tax credits is not only who can use them against their own taxes, but who can use them as sort of a financing tool to build something or to get something moving. And so when we're thinking about tax credits, a lot of the people we're talking to on a daily basis as professionals in this industry are developers. And they're developers of electricity plants, of fuel plants, things like that. They're also housing developers in some cases, right? Residential solar panels are a big deal, particularly in the Southwest. These days, we're also talking about people who are working on manufacturing plants. Now, usually those are the people who are going to be manufacturing widgets or whatever, but they are in fact developing manufacturing plants or rehabbing manufacturing plants. The manufacturers that we talk to typically are folks who are engaged in manufacturing widgets for clean energy production. But in some cases, we're also talking to manufacturers of pretty much anything who want some kind of an energy efficiency upgrade at their manufacturing plant. Traditional real estate investors often care about these tax credits for a couple of different reasons. In some cases, you might have a real estate investment trust or just a regular fund that has a lot of real estate investments, and they would like to reduce some of the energy costs. Or perhaps they feel that there's a beneficial message for their tenants or whoever if there's a green energy overlay with the real estate. Banks often like tax credits for two reasons. One, banks can use tax credits pretty regularly on their own balance sheets or on their own tax returns, I should say. And a lot of banks also engage in sort of syndications or almost brokerage activities, basically matching clients in their own client base against tax credits that are available. Insurance companies also care about tax credits a lot. The returns on these kinds of investments are nice and steady. They're not massive, but they're nice and steady, which is a good fit for insurance companies usually. And basically, really anyone else who wants tax credits. These days, post-IRA, that can be pretty much anyone, including private individuals, although typically we're talking about quite high net worth private individuals who have a lot of passive income from other things like real estate investment. Now, what are the tax credits for? I listed off a few of these things a couple of minutes ago, but a little bit more specifically. Now, this is definitely a little bit of a number or maybe an alphabet N number soup. But what we're really thinking about with the tax credits at the federal level today is things like wind power, solar power, geothermal and landfill, things like that, where there's an electricity production. Now that's today under a couple of different credits. After this year, some of those credits will switch for electricity and they'll become technology neutral or technology agnostic, where we're really looking at electricity generation using pretty much anything, as long as the greenhouse gas emissions profile is neutral. That means different things to different people. One of those things that I'm happy to pick up offline. We're also talking about carbon capture and sequestration or utilization. Some of you might have heard about how you can take carbon off of an industrial plant. A lot of industrial plants emit carbon dioxide. And you can put it into a greenhouse, for example, and grow algae. Okay, well, that's an example of utilization. But you can also take that carbon dioxide and mix it into concrete at the concrete plant. That's a kind of utilization too. Actually makes the concrete stronger in some cases. So that's one option. It's expensive to do all those things. I mean, just capturing something that otherwise you're going to put out into the air, unless somebody's forcing you to capture it, that can be pretty expensive and kind of complicated too. That's why we have a tax credit for it. Clean hydrogen is very much the new kid on the block. It's gotten a lot of attention in the news and in science and so forth over the last several years. We do have a pretty powerful tax credit for it now. And what I mean by clean hydrogen is anything from hydrogen produced using electrolysis, like membranes, water, electricity, things like that, to hydrogen that's produced using methane, aka natural gas. Now, the credit works differently based on the greenhouse gas emissions profile of the hydrogen, but it is a credit that's available. I've seen activity around it in Arizona and elsewhere in the Southwest as well. There's some tax credits for electric vehicles and hydrogen fuel cell electric vehicles. They come in two flavors, one for consumers, those of us who have an EV in the garage, and then also one for more of a commercial application or a fleet vehicle application. They work very similarly, though there's not massive differences. There's also a tax credit for fueling stations for electric vehicles and hydrogen. Now, we've had that for a while. It was revamped under IRA, so it makes a little more sense today than it used to. We also have a couple of different manufacturing credits. This 45X one is a per piece manufacturing credit for specific kinds of widgets. Some of you are probably familiar with the name First Solar. First Solar is a solar panel manufacturer. It's a rather well-known American manufacturer. This kind of credit is very useful for companies like First Solar, who manufacture certain things in the United States. They can claim this credit. In fact, rather famously in the industry, First Solar just sold off something like $500 million worth of these tax credits in December. 48 is another electricity category. It also covers energy storage and renewable natural gas. There's some renewable natural gas down in Arizona, lots of it in California. I'm sure some of you have come across that industry. I mentioned the other manufacturing credit, 48C, which is the manufacturing credit, is also for improvements of manufacturing buildings to increase their energy efficiency. That one is application-based, so it's a little different. Most tax credits you don't have to apply for. They're just there if you qualify for them. 48C you have to apply for. And there are a few others in there too, some energy efficiency credits, some nuclear electricity credits. Now, I mentioned after this year, the credit scenes changes a little bit. Most of the ones that exist today will continue, other than the electricity credits under 45 and 48. Those will convert, if you will, to sort of a zero emissions electricity credit under 45Y and 48E. Most everything else stays in, although we do end up with a new fuel-based credit for clean transportation fuels and sustainable aviation fuel. So as you can see, there's a lot of different activities that can qualify for tax credits today. Frankly, it can actually be a little confusing. But the point is, I think really over the last 18 months, I've had very few conversations with people where I have to say, sorry, what you're doing just doesn't qualify at all. Usually we're able to find some kind of a nexus with the federal income tax credits. Now, you saw on the last slide, there are basically two flavors of tax credits. Let's start with the easier one to understand. One flavor is the investment tax credit, or ITC is the acronym that I used on the last slide. This flavor of tax credits basically is concentrating on capital expenditures. And so the credit is a percentage of qualified costs. And qualified cost means something. It's easy to understand in the context of a solar facility. If you go look at a solar facility on the side of the highway, what you'll see is a bunch of pieces of steel shoved into the ground. On top of them is some racking that holds up the solar panels. You'll see a bunch of wiring. You'll see some inverters. You'll see a substation. Most of what you see at a solar facility qualifies for the tax credits, the vast, vast, vast majority. Usually it's around 93 to 95% of the total cost. Now that analysis changes a little bit depending on the project, as you might expect. Regardless, whatever I can find at that project, and I do try to find everything, a percentage of whatever that cost in terms of capitalized costs, for those of you who are tax nerds like me, the percentage of that qualifies for the tax credit. Now that tax credit comes into being, it's available in the year in which a project is placed in service, which is basically tax lingo for I can use it now. And that depends on permits. It depends on whether or not I can put the electricity on the grid or the fuel on a pipeline. It depends on who owns it and whether or not the construction's done. It's a multi-factor test, but not all that hard to understand, generally speaking. Now, the person who gets it, this is where it starts to get a little more interesting. Generally speaking, the person who owns the qualified project is the one who claims the tax credit. Now, I've got lots of different ways I can slice and dice that within the tax law. In some cases, I can pass the tax credit on to the lessee, only in the investment tax credit context, though. So, for example, if I own the solar panel and Sean wants to lease it because he wants the tax credit, I can lease it to him, he can operate it, and I can elect to pass the tax credit to him. That's a valid option. There's also this concept of tax credit transfer or sale now. That was a feature of the IRA, pretty revolutionary, frankly. And we'll talk about it in a little bit. Now, what qualifies? We talked a little bit about the capitalized cost here and what bits and pieces qualify. Generally speaking, when we look at that solar facility on the side of the highway, we're thinking about, well, what bits and pieces in this project are really integral to the production of electricity? Or if we're looking at the dairy farm that's got a renewable natural gas digester associated with it, well, what bits and pieces of that digester project are essential to the production of renewable natural gas? That's sort of the analysis here. It varies from technology to technology, but not necessarily all that wildly. Now, there are a couple of consequences to take into consideration here. One, if you get that tax credit, well, if you also then use tax deductions to depreciate the whole cost, you're kind of double dipping. And so what Congress has done is they said, okay, fine, if you've got an ITC on this property, here's your ITC, go claim it, use that to offset your tax bill on a one-to-one basis. But you kind of got to pay the piper a little bit. We're going to reduce your depreciable basis for that project by 1/2 of the ITC. So what that means is basically you can still take depreciation deductions on the project. You just don't get to take all of the depreciation deductions that you would get if you didn't claim that ITC. It's not a massive consequence, but it is something to take into account in financial models. Now, the other flavor of tax credit is called a production tax credit. Now, production tax credits are generally available with respect to specific kinds of facilities. Facility is basically anything and everything that you need to produce whatever it is that Congress wants you to produce. And so the tax credit is based on the production of that thing. Maybe it's electricity, maybe it's something else. Generally speaking, the credit looks really, really low. It's an annually variable rate that is quite low, but it's based on an amount produced, essentially. So if I'm producing a kilowatt hour of electricity, that's not actually that much electricity. And so the credit associated with it is going to be kind of small, but it adds up over time. Now, there are other things that have to be done in order to claim some of the production tax credits. It's not good enough to just produce electricity and then just let it discharge into the air, or produce fuel and then flare it, right? For most of the tax credits, you've got to sell it, whatever it is that you're producing. You got to sell that electricity or that fuel or whatever. In some cases, you can do something else with it. So with hydrogen, you can sell it or you can use it in some kind of productive use. Now, that's important because hydrogen can then be turned into ammonia or methanol, both types of fuels that have other applications, but also are easier to transport than hydrogen, which is really crucial. With carbon capture is kind of a funny one. Of course, you're not producing the carbon, you are capturing the carbon. And in order to get the credit, it's not good enough to just capture it. You got to go do something with it so that it's not going to go back onto the air. And so usually today, that means you're going to go put it in a hole in the ground somewhere. And you're going to use that carbon to pump out some methane or something like that, natural gas or oil, for example. That we're moving away from that in the tax credit structure and much more towards putting the carbon in the ground and getting nothing out. We call that geologic sequestration. Some of you might have heard the term Class 6 well. That's a concept from the EPA where you put the carbon in the ground and you leave it there and hope it doesn't come out. Now, the production tax credits, because they are so low, the key with them is that you actually claim them for quite a while. Most of these credits, it's a 10-year period. So you're producing stuff for 10 years and you're claiming the corresponding tax credits every year in that 10-year period. Carbon capture is a little longer, it's 12 years. Manufacturing is a little funny. That manufacturing PTC, it's only available through 2032. And actually the last couple of years that it's available, it's a reduced rate because it's supposed to be sunsetting. And basically it's supposed to have done its job in the first several years that the law was available. Whether or not that's going to happen is another question. We'll see. Also, the clean transportation fuel credit, it comes into play next year and it's only available for 2027 right now. Now, that one could be quite lucrative. And so maybe the short-term period is acceptable. Really, the short-term period exists because there was concern about continued use of transportation fuels that are sort of methane-based. It may be extended though. Now, who gets the production tax credits? Generally speaking, it's the owner of the commodity that's produced, which is usually also the owner of the facility. They often go hand in hand in the code. Sometimes there's a transferee. All of these tax credits that are PTCs, you can actually transfer them or sell them. The manufacturing and hydrogen credits, one thing to pay attention to here is there's a little more variability as far as who can claim those credits. It comes down to contracting, but it's possible to play with it a little bit more. Now, what qualifies? Generally speaking, for both of these tax credits, we are talking about new spend, okay? It's usually not acceptable to take a facility that's been operating for the last 10 years and just because the law changed, start taking tax credits. The whole point of IRA, the whole point of all the tax credits, which technically have been around for decades, the whole point of these is to encourage investment, private investment into types of technologies, types of production methods that Congress sees fit to incentivize for various reasons. One thing that we have in today's credits is sort of a different structure. It used to be pre-IRA that we would really kind of stop the discussion here. We would say, great, you did something that qualifies, keep doing that and claim the tax credits. Under IRA, though, we have a little bit of a different analysis, a different calculation. And this goes really very closely into congressional intent. So all of the tax credits today are premised on sort of a very low base. ITC is the easiest to understand, so let's just discuss that one. The ITC base right now, the investment tax credit base, is 6%. So go build your solar plant, good for you, you get a 6% tax credit. Now go try to finance that or monetize it, good luck. It's going to be hard because nobody really wants a 6% tax credit. It's just not competitive. And so Congress knows that. And so what they did in the IRA is they said, okay, the only way you get up to 30%, which was the historic rate for the ITC and is financeable, is by complying with prevailing wage and apprenticeship rules. Now, we're not going to go into a whole lot of detail here, but suffice to say, those of you who are familiar with government contracting in the United States, you know that prevailing wage has to be paid on construction projects. It's under the Davis-Bacon Act, which may sound familiar. And so basically what Congress did in the tax code is they used concepts like the Davis-Bacon Act and said prevailing wage has to be paid now. Oh, and also you've got to comply with some apprenticeship rules. Now, this doesn't mean that developers suddenly have to become all unionized. What it does mean is they need to make sure that they're paying their teams and their subcontractors are paying their teams prevailing wage in the area where the project is going up. Now, I've looked into prevailing wages in Arizona. They're kind of low, generally speaking, so it shouldn't be much of a problem there. The bigger issue is apprenticeship. Apprenticeship rules, they're not that hard, they're not that strict. The problem is trying to get apprentices. And this is a big challenge. And I think one of the reasons why Congress introduced this requirement is because of a perceived need to increase the workforce in skilled trades, frankly. It's been a struggle in the renewable electricity industry, for example, for several years, just trying to find people who are skilled in some of the jobs that are needed in project development. And so this apprenticeship requirement is intended to basically say, look, you want taxpayer money, you better invest in our country's economic development. It's sort of a tit for tat, and you have to do it. If you don't do it, you ain't getting the tax credits, and you're not getting your project finance. Now, there are a couple of other sort of bonus credits here that we have now under IRA as well. One is about domestic content. That's basically about buying a certain threshold amount of equipment in the United States. Now, this is a bonus credit, so it is actually kind of hard to meet. Those of you out there who are from, state and local government or from a nonprofit, we'll get to you in a little bit, but you do need to pay extra attention to domestic content rules because for you, they're actually required. It's not just a bonus credit. You actually lose some of your regular credits if you don't meet domestic content. Those rules are very complicated. They're very twisty. They're likely to be changed in the not too distant future because they are so difficult. But the industry is adapting. We're figuring it out for the most part. So if anyone wants to know more about the domestic content rules, I'm happy to talk to you offline. You can also check out the webinars on our Perkins Coie website. Just Google tax credit evolution, Perkins Coie, and you'll get to the webinar that I did last year. There's also a bonus credit for energy communities. Now, energy communities are certain locations in the United States, generally speaking, that have historical ties to the oil, gas, or coal industry. Now, those energy communities come in a few different flavors, right? So one, a very desirable one to be in actually, is an energy community that's tied to a disused coal mine. A coal mine, basically, it's been closed sometime in the last 20 or so years. Those are easy qualification locations because they're fixed in time. They never change. There's a similar one for locations that are near disused or closed coal-fired electricity generation plants. Also very useful. You all have some of those. I think they're up in the northern part of the state for the most part. There's another category that's tied to historic employment in oil and gas. But that one also requires that the location have an unemployment rate that's higher than the federal rate. That can change from year to year, so it's a little less fixed. We have some tools to try to take advantage of it on a long-term basis. For those of you who are interested in that, you can find a map of these locations. Go to Google or your browser and search for Energy Communities Map. There's a government website that has the map on it. It's actually fairly user-friendly. Now, there are a couple of additional bonus credits specifically for small solar and wind. Okay, so this is 5 megawatts or less. This is useful, particularly in low-income areas and also Indian lands, so reservations as well as other kinds of Indian lands. This is useful, particularly for community solar or community-like solar, as well as distributed generation in more rural areas. It's a bonus credit. You have to apply for it. It can be 10%. It can also be 20% if you can demonstrate that there's an economic benefit to low-income residents. It's difficult to get. There are different categories even within the application. Candidly, the application materials are kind of not that helpful. The 2023 set of applications is about to close later on this month. But there'll be another allocation for 2024 and for several years beyond that. So what that means, generally speaking, is that for the ITC, for the investment tax credits, for small wind and solar, it's possible to get up to a 70% tax credit, which is pretty compelling. For regular wind and solar and other kinds of ITC technologies, it's up to 50%. And I have seen a few projects where they think they can get 50% or at least 40%. The PTC is a little different. You can only use the energy communities and the domestic content adders with the PTC. The low income ones are not available. And in the PTC, remember, it's a small credit for a long time. And so what the adders there do is they actually just add percentages. So it's 120% of what we think of as the base PTC, which is the low base with the prevailing wage and apprenticeship. Okay. Now, I mentioned earlier, there are a lot of people who care about this stuff, and I want to reiterate here that tax credits are not just about tax credits, frankly. They're a financing tool, okay? What we do with tax credits is we take them to the bank, literally. People borrow against them. People get equity interests because of the tax credits. They're basically selling the tax credits. People sell the tax credits and get bridge loans to underwrite or to bridge that gap between when the project is placed in service and when they get paid for the tax credits. They really are a financing tool. Are they the most perfect financing tool in the world? No, but they are functional. And for whatever reason, you know, this is just how we do things in the United States. The other thing about tax credits is that they add on to other stuff. They make other things possible. So we've seen all over the country that there's an increased focus on regulatory compliance around greenhouse gas emissions. There are voluntary compliance programs. A lot of you are familiar with some of the really big name corporates: Amazon, Microsoft, Stripe, Google, Salesforce. A lot of those big name corporates have specific kinds of voluntary compliance programs around what they want to do with greenhouse gas emissions. Tax credits are a way to make some of those voluntary compliance goals reality, frankly. Grid stability issues. I mentioned earlier, there's a credit for batteries. Grid stability is a big deal in parts of the country. Even parts of the country that don't have a lot of renewables, grid stability is still an issue. I live in Portland. I was out of power for 9 days last month because of these 3 back-to-back ice storms. It would have frankly been pretty nice to have some batteries in my local neighborhood for when they got a few of the lines back up, but not all of them, right? Fuel stability is also an issue. We've got questions around natural gas and oil in this country. Yeah, we've got a lot of supply, but it's not everywhere, right? If pipelines go down, or God forbid, there's some kind of a military attack on our pipelines or our infrastructure, it sure would be nice to have some distributed production, and renewables are good for that. There's also cost saving potential, right? Renewable technologies can actually be a lot cheaper than traditional technologies these days, at least in parts of the country, for electricity and also for fuel production in limited cases. So those are the things to keep in mind here. It's not just about the tax return. Think beyond that here. Now, the ways that we can think beyond that, the ways the tax credits are used as a project financing tool are not multitudinous, but there are a few different options, okay? Traditional structures that we use and still use today are things that we call partnership flips. And this is a fancy sort of exotic term for basically a joint venture, an investment, in other words, where somebody builds the project and somebody else puts some of the money in. They come together, they form a partnership. Each of them owns a piece of that partnership. It's usually a limited liability company, technically. And then that partnership owns a facility and operates a facility for some period of time. Now, that investor wants specific things. That investor really just wants the tax credits. Because of how the tax law works, they can't just have the tax credits in that structure. They also have to have sort of some skin in the game, right? They have to have some potential for loss. They have to have some potential for profit. Which means that they get some of the depreciation deductions. It also means they get a little bit of cash. Now, there are a couple of other variations on partnership flips that we don't need to talk about. It can get a little complicated, but suffice to say, they work. And frankly, we've been doing them for so long that we have pretty decent models. And those of us who practice in the industry, the negotiation doesn't actually have to be that hard because most people understand what the market will tolerate and what's normal, right? Now, sale leasebacks are another sort of traditional structure for the ITC. You don't see this in PTC. Sale leasebacks are equipment financing, basically. And so many of you are probably familiar with your options for going out and buying large equipment, whether that's a combine or a crane or a fleet vehicle, right? Often what will happen is you'll go to the bank, you'll say, I need 10 more cars for my delivery fleet. Will you finance it? And what happens often is the bank will actually own the title. They'll own the vehicle. You'll operate it and you'll do it under a lease. That's usually, that's a pretty well-known structure. We can do it in ITC too. And often you'll see some traditional banks, some regional banks. You also see some of the larger banks. And you also see some private shops that really specialize in equipment financing do this. What they do is they provide the money to buy the equipment or to build the equipment. And in return, they have the titles of the property. They get all the tax credits. They get all the depreciation deductions. They also get some of your money besides. Now, we have some new structures under the IRA. IRA was pretty revolutionary, and that's the Inflation Reduction Act, again, as Sean mentioned earlier. The IRA was very revolutionary in 2 different respects, particularly for those of us tax nerds. One, we now can sell tax credits. Now, it has been possible in the past to sell tax credits on a very limited basis in the past. But now all of those tax credits that we talked about earlier, I can sell just about all of those. The vehicle credits, we have some strange rules, some different niche rules. But with almost everything else, I can just sell them outright. Now, is that uncomplicated? No. Is it less complicated than a partnership flip? Yes. Particularly for PTCs. ITCs are a little more complicated. But the point is that there's a market that's developed and is continuing to develop with actually pretty decent pricing for tax credits. you're never going to get paid the full value. You're not going to get paid $1 for $1 of tax credits, but you might get paid 92 cents, which is not bad, particularly given that the seller, if they can use depreciation deductions, they keep the depreciation deductions. And perhaps more to the point, they don't have some silent or not so silent, as the case may be, partner involved in their business who they have to deal with on a regular basis. That's a pretty attractive proposition for many businesses. Now, the other thing that was pretty revolutionary about the IRA is this concept of elective pay or direct pay. Now, this is an interesting concept, and there were many people in the taxable world who were advocating for it. Direct pay basically, instead of using a tax credit, which you have to have tax liability in order to use a tax credit, or at least these kinds of tax credits, what they basically said is, do we have the ability to instead have Treasury pay us directly, just cut us a check? And Congress basically said, interesting idea. You can't really have it most of the time, but we'll let you have it in a few cases. So taxable people, taxpayers, can get direct pay for the first few years when some kinds of PTCs are available, specifically hydrogen, carbon capture, and the manufacturing PTC. What that means is that those people who are making hydrogen or capturing carbon or making bits and bobs, they can claim direct pay for a few years. They have some on-ramp, basically. After that period of time, they got to do something else to use the tax credits. Either hope they are making enough money to actually have to pay the tax man, or figure out a way to monetize them by selling them to someone else or getting an investor. Everyone else in the tax exempt world, as well as electricity cooperatives, can use direct pay all the time. Now, this is particularly interesting for 501c3s, your typical sort of nonprofit. I didn't list on here tribes. Indian tribes can use this too, which is pretty interesting because I know there are a lot of tribes in Arizona and other parts of the West who have been very interested in tax credits and renewable electricity and have been pretty hampered over the years. State and local governments can also use this. Down in your part of the world, that could be the city of Phoenix, it could be SRP, Salt River Project. And also electricity cooperatives like AAPco can use these too. What it means is that if I'm, the city of Phoenix, for example, and I have direct ownership of a project, solar facility, or what have you, then I can claim the tax credit in the form of a check from the United States Treasury. That's pretty helpful because it's a one-to-one. If I'm going to earn $100 of tax credits, Treasury will pay me $100. There's no loss there. And more to the point, perhaps, we don't have quite the cost of financing the tax credits, which is really helpful. I've actually been pretty surprised by the rate of uptake of direct pay. I have a number of clients at this point who are state and local governments or agencies who have picked this up, as well as some tax exempts. So it's a really attractive option. It's not risk-free. There are some potholes you need to be aware of, but it is a nice tool. There are some differences between how the ITC and the PTC work into direct pay. For example, a lot of exempts and governments and tribes and so forth will finance capital expenditures with grants or with tax-exempt bonds. Some of those tools can reduce the amount of tax credit that's available, particularly the ITC, but we also have to worry about the PTC in some cases. So be careful about how you're filling out your capital stack for the project, but it is a nice tool to keep in mind. Now, one note on both transfer and direct pay. In order to transfer tax credits or claim direct pay, it is essential to register the project with the IRS. It must be done. Otherwise, you will not get that check. The registration process is not that hard, but it does take about 120 days for the IRS to give you the registration number that you have to have in order to complete the transaction. So always, always, always plan ahead when you're looking at a transfer or direct pay. That's it for today. There are a lot of details here that we could talk about probably for hours and hours. A couple of things to keep in mind. Obviously, Greater Phoenix has several other webinars up on their website. I'm sure Sean will reiterate where those are in a minute. Perkins Coie also has several webinars that I've done over the last several months on various aspects here. All of those videos were released right after we got proposed regulations from the IRS interpreting the IRA. One note about that, most of these rules are in statute now. They also have proposed regulations or proposed rules for most of these things. Now, those proposed rules are subject to change, right? We've had comment periods, pretty lengthy comment periods for most of those proposed regulations. We will get final regulations eventually. Hopefully we'll get most of the final regulations by this summer. It would be helpful to get them before the next election because there are some things that can happen if they come out during the election that we don't really want. And so we'll see when those are released, but most of the time taxpayers can rely on proposed regulations right now in order to make business decisions. And that's the most important part here, is that people have enough information in order to make those business decisions that are important for not only building your own facilities, but also investing in other people's or buying power or buying fuel from a facility. It's important to make sure that you're actually going to be able to get what it is that you need to buy. So with that, I'll turn it back over to you, Sean. Thanks so much for joining us today, and I appreciate the opportunity to be with you.
Well, thank you so much, Elizabeth. That was an extremely insightful presentation. We appreciate all the details on the investment tax credit and production tax credits. As we wrap up, I'd like to ask you, in the last 30 seconds, if you have any final remarks that you'd like to share with the audience.
Just one thing to really bear in mind, and I want to just reiterate here, don't think of tax credits as just tax credits. They are a tool in the toolbox. They can be useful for a lot of different things, whether you're thinking about trying to get cheaper electricity for your business, or you're thinking about how you can positively impact the stability of your electricity or fuel supply. Think outside the box. Don't think just within your tax return.
Thank you again for the presentation. And hopefully this webinar will spark an interest among our viewers to learn more about the Inflation Reduction Act and how your company can and should leverage all the different programs, tax credits, incentives, and grants. Please contact GPEC if you have any questions or need introductions to service providers. GPEC services are free of charge. If your company or client is exploring setting up or expanding operations, don't hesitate to contact GPEC. We'll be happy to assist with your site selection and due diligence. And I'm just going to very quickly show our GPEC Climate Tech resource page. So I would encourage viewers to come and visit the GPEC Climate Tech resource page. It's under the industries, and you just click on Climate Tech. And we'll be sharing resources and information about the Inflation Reduction Act on this webpage here. And we'll also post the videos on this webpage, and it'll link to our YouTube video for this webinar.
Sean, I just wanted to mention one thing. Thank you, GPEC, for this opportunity for us to help make this presentation. We want the best for Phoenix and the surrounding area, the greater Phoenix area. The Phoenix office at Perkins Coie is much appreciative of the opportunity for this presentation today.
Well, thank you very much, Elliot and Elizabeth. I mean, we greatly appreciate the support from Perkins Coie, and we'd like to thank all of our viewers for joining us. We hope you found the presentation informative and valuable. This concludes our program. Thank you.